This video is trying to explain one of the more complicated investor ratios, the price to earnings ratio. This can be used to strengthen your analysis or evaluation in an accounting essay in this field, but you've got to be very cautious to make sure you understand exactly what it means and how it could influence a potential shareholder. So price to earnings is calculated by market price divided by earnings per share. So if we are looking at a high price to earnings ratio, this could imply that we're paying a lot for every pound of profit. So the market price is quite high, but the profits are not currently there. So why could that happen? This is what you need to question. So the reason for the market price being high could be investor confidence. So it could be shareholders are looking at it or financial analysts are looking at this business and saying there is the potential for high returns in the future. So this business is growing, it's got some options in the future, so it's going to generate more profits, which means that in the future dividends and future share prices could see a return on investment. Now, clearly there's a risk here. Please do not oversimplify high risk. Sometimes students go, oh, high risk is high reward. This means you're going to make lots of money. There is the potential to make lots of money, but there is equally the potential to lose a lot of money. So a high price to earnings ratio means they're not making the profits now, so the risk is there that you will lose all of your investment. Conversely, a low price to earnings ratio could be a sign that a business is undervalued. So you're not paying very much for every pound of profit. So it could be you're making a good deal, and it could be eventually this figure will increase. You do need to question investor confidence here. Why is the market price lower? Are financial analysts thinking that this business isn't going to grow, so therefore the dividends will not grow in future, and therefore you might also lose money on the share price? However, sometimes companies lose value because of short-term problems. If you look at Marks and Spencer with the cyber attacks that have happened recently, there's going to be a massive impact on their share price, which in the longer term, when I'm sure they're hoping to resolve it fully, the share price will go back up, and that would increase your price to earnings ratio. So you'd need to have a little bit more research into the business and why it's a low PE ratio. So when we're looking at industries, we look at how the industry has an impact on what the PE ratio should look like. So technology-based companies are a really good example of those which have high PE ratios, especially in emerging industries. So if you look at AI currently, AI businesses have massively inflated share prices because there is the potential they're going to make huge returns in the future. But which business will make a huge return? That is the gamble. And that is, like I said, the high PE ratio is a high risk, but potentially a high return. So you could invest in the AI company that's going to make you a huge amount of profit on the share price and eventually pay you large dividends, or you could invest in the AI company that's going to go badly wrong and close. This happened in the late 1990s with the tech boom, with lots of internet-based companies having huge increases in their share price, such as Amazon, lastminute.com, Friends Reunited. Now, the first one, Amazon, you know about. If you bought shares, if I bought shares in Amazon in the late 90s, I'd be seeing a huge return on investment and probably wouldn't be making this video now. However, if I bought shares in lastminute.com or some of the others that have closed, I've lost my money, I've lost my investment. So that shows that high PE ratio has the potential for huge success and huge failure. However, a low PE ratio sometimes you might see as a mature industry, not growing too much, market price is steady, profit is steady. So the PE ratio is just indicating maybe a safe industry, maybe one where you're going to make regular returns, not too exciting, but for an investor, that might be reassuring. So when we're making a judgment and linking it to the price to earnings ratio, we want to question the investor's attitude to risk. Are they a risk taker? Are they more risk averse? Now, clearly, that would have a little influence as to whether they want to pick a high or a low PE ratio. Are we looking at dividends? Are we looking at trying to be paid dividends, or are we looking at make money on the share price and making a capital gain in that way? If we're looking at the share price gain, we might be looking for more of the high PE ratio because they're not making a lot of profit now. So the chance of you being paying a dividend is quite low. What would you like to know? What would you want to know about that investor and how that would influence your judgment as to whether they want a high or low PE ratio? So do they want to invest in high risk stocks? You've got to know information about the investor, and if you don't, that's your limitation. Your limitations that will help you strengthen your analysis, strengthen your evaluation, and achieve the level 4, level 5. If you don't have the PE ratio given to you in the essay and you have the market price and you have the EPS, calculate it, use it, but only if you understand it. If you get the application of the PE wrong, it can heavily weaken your analysis. Good luck.